We followed through on yesterday's selling with a little bit more today. IWM, it seemed to shift from the large cap stocks to the small cap stocks today. Kind of middle of the day, it made that shift. So it'll be interesting to see if that continues into the weekend and through options expiration into next week. There are a lot of signals suggesting these mega cap names and NASDAQ 100 in general has an opportunity to bounce going into next week. We'll take a look at all those signals and share with you a time where that has happened in the relatively recent past to see whether or not we get a very similar outcome. We'll also talk about not just the similarities to that analog, but also some of the differences that suggest what I expect this one will do, whether or not we'll actually follow that analog or do something different. So we'll talk about all of that in today's video. Take a look at that change. Even though there's been a big change in leadership from a longer term perspective, seemed to be a big change in leadership to the downside today. So we'll break that down, the rotations, the breadth changing today as well, a weakening to a degree today as well. And then we'll take a look at how the sectors move, and then our trade idea in one of those areas that struggles. Using a intermarket relationship that's typically correlated with the S&P 500 to kind of give us the trade idea and to take it. We'll talk about how to take advantage of that and how to trade that. So let's go ahead and get started. Today is Thursday, July 18th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old trades. We see whether we should get in or out of, older trades that we've done in previous videos. We also already put on today's trade before the market closed in that class. So check that out there. Come down to the bottom, click this heart. It opens up this tab. Click the same thing, click this thumbs up icon, opens up this tab, hit those like buttons there. It helps get our content out to all of our followers on those platforms, so thank you. Those who do that day in and day out, those who don't, you can do right now with one or two really easy clicks. Let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator like we always do. As you can see here, we continued our decline from yesterday into today. Still not down more than 1%, a little bit yesterday, but not today, not down more than 1% here. We did end up with a bearish near-term low point. So we talked about that second day getting below 20. Well, we did. So now we follow the bearish near-term high with a bearish near-term low point. And now which makes it unlikely that we'll come right back up, at least in the next day or two, getting out above 40. So unless we really, really bounce up sharply, it's a pretty bearish short-term sentiment. We are less than 1% above, but we are still above the moving average by almost 1%, so it's not bad. The intermediate line has crossed below the market sentiment line, which is typically bearish, right? You can see it happened over here, but it also happened a couple of times earlier. So, there's a chance that we can turn right back up with some. Now, granted, all these other instances here, we didn't have bearish short-term sentiment. We finally got it over here and ultimately ended up crossing below it after. So a little different scenario there. If you look at the NASDAQ 100, it's even worse, right? We had a bull tag, and this is the worst short-term sentiment that we've had on a day where we've got a bull tag since all the way out to, I believe I have to go out further here, all the way out to early 2018. So this was the last time that we had a bull tag with short-term sentiment that was as bearish as we are right now. So it kind of goes to show just how significant, like pretty good likelihood that this bull tag, even though we're only 0.5% below the moving average, and so because of that, you can see when you're just a little bit below the moving average, you have a good chance at bouncing. So there's a good chance that we do bounce off of this. But again, even on these instances, this was probably the one, the last time we had bearish short-term sentiment. And we were barely below the moving average there. And so again, similar to earlier part of this year, we have an opportunity to really bounce up and take off again. So we'll see if that ends up being the case. Market sentiment or intermediate line is below market sentiment. It is below the 80th percentile. So there is that chance that we can really bounce off of here up to the upside. If you take a look at the Russell 2000, see things have changed there. You can see we've gone from being above 80 on the near-term line to now being all the way below 40 already. So we're below 460. So this is the first day, right? First day below 60. The momentum line is down to extreme lows, or really close to extreme lows. This is kind of an evening star candlestick pattern up here. So there's a good opportunity, a good chance that the near-term line falls down into the reversal zone tomorrow, that we continue this decline of almost 2% today into tomorrow. So that kind of suggests a weakness coming up here on a short-term basis. And then finally, your Dow Jones Industrial Average, same thing, right? It didn't drop. The near-term line did not drop because it was so high. It did not drop out of bullish territory yet, but you have very bearish momentum line that suggests that things can turn south here pretty quickly. You notice we don't typically get, when we're bullish, we don't typically get that momentum line dropping this far when we're this bullish, especially when we're this far up above the moving average. So we'll see how things turn out going into the end of the week here tomorrow, which keep in mind happens to be options expiration here. So you tend to get some pretty interesting moves on options expiration days. Let's take a look at the weekly chart for the S&P 500. You'll notice here that a new thing about the weekly chart here is that we have a lower close on the Hakanyashi, and a little bit of a lower shadow. So you're starting to get a little bit of a neutral candle here. We did get a higher high, intra-week high, but that lower close and the line crossing below the moving average suggests a good chance that we could move into a transition next week, transition candle next week. Now, keep in mind, we are getting a transition candle already on the NASDAQ 100, right? That's a pretty good transition candle there. Remember, we still have one more day left, and it's a pretty bearish candle. So that suggests now we haven't got the red arrow yet, right? So we still don't have the red arrow. Sorry, it's going to be right here. We still don't have the red arrow yet on with the close below the 10-week exponential. So we'll see if that ends. You don't typically have to get that on the transitions, but we are, it is a bearish candle now. We are slightly below zero. We are still in the 94th percentile of how wide these two lines are away from each other. That's what this is measuring down here. So that's a pretty significant pattern there. Again, you look at the Russell 2000, which barely broke out. Right, we got this significant bullish candle here. The question is how extreme that is and whether or not we can build off of that. The other times we've been this bullish on that candle were the end of these moves, of both of these moves. So a little bit, maybe too much of an extreme candle on the Russell 2000. Let's take a look at the 3 green arrows chart. So you obviously have 3 red arrows now in the Qs. Still a yellow line though, but you have 3 red arrows in the Qs. Again, same thing. We can bounce off of this. As I showed you earlier in the year, we had that 3 red arrow signal right there. We bounced off. Now we didn't have 1.5 times the average volume like we do now. So it's a little different story there. And same thing over here. We had 3 red arrows. We did have 1 day of average of above average volume, and we bounced up for just maybe another week later, and then that was it. So that's something to keep in mind in terms of getting 3 red arrows with kind of below average volume is not that big of a deal. 3 red arrows with more than 1.5 times the average volume may be more of a bigger deal. If I zoom out, you can see the S&P 500 is in convergence mode with the red arrow on the MACD, whereas the diamonds and the Russell 2000 still have pretty strong MACD histograms that are falling, but they're still, we still have a green arrow, still way above moving averages, and the stochastics are easily in bullish territory as well in the upper reversal zone. So we're actually probably not, if worst case scenario, we probably still wouldn't get even 1 red arrow for another day, another couple of days on either of those 2 indexes. That's how bullish that they've been. The S&P 500 did break slightly below the 17-day moving average, barely. The MACD, as we mentioned, is negative in convergence mode. The stochastics is out of the upper reversal zone, but still in bullish territory. The Qs, we are now easily below the 17-day. The MACD is easily falling here. So again, going back to the beginning of the year, we had something very similar, right? We got a little bit below. The MACD was coming down to 0, and then kind of we halted right there. The stochastic was a lot lower, so that's a little different than now. The stochastics is still a lot higher here. And again, the average, the stronger volume suggests we may be a little bit more bearish now than we were at the beginning of the year. And when you look at some of these other oscillators, look at the DMI for the S&P 500, and you can see, okay, we're not we don't have the bearish crossover, but and the ADX is starting to fall, but we haven't crossed yet. We haven't crossed above 25 on the negative. We haven't crossed below 20 yet on the positive. We have on the Qs. So those have made that crossover. Now again, at the beginning of the year, we had a similar level, right? The negative line got up to a similar level. The positive line got down to a similar level. So they still can rebound from here. There's an opportunity for this to rebound. The ADX was high then, it's high now. So, and it turned pink with that bearish crossover there. So we'll see, how that plays out over the next little bit. Again, very similar to that early January bounce period. Looking at the RSI and the CCI, we are out of bullish territory on both indicators here, but not bearish on either one of them. The Nasdaq's a little bit of a different story. We're in the lower half of the chart now, still not below 40, but we're in the lower half of the chart there on the Nasdaq, and we are below minus 100. And again, you can see we got below both those levels here in beginning of the year, and we rebounded. You can see when you barely get below 100 on the CCI, you tend to rebound pretty quickly, and same thing with dipping your toe below 50. So as of right now, that's all this is, a little bit of a toe dip below these levels, and we're still set up for this to bounce. That's kind of why we made the trade yesterday on NVIDIA, for that very reason, in case we were to bounce off of these levels. As you saw, NVIDIA pretty much already did here today. Ichimoku Cloud is still very strongly bullish for both the S&P and the Qs, right? So they're still very strongly bullish. We are below the blue line on the Qs, so it's a little bit less bullish than the S&P 500. So we might be maybe a day or two away from both these indicators dropping to 0. Now they did drop to 0 at the beginning of the year. It was actually not on the 4th, but the next day on the 5th they dropped to 0. And we still bounce. So even that's not necessarily an issue, and it's definitely a very good sign if we were to bounce without it dropping below 0, because we can maintain the very strong bullish trends that we have. Looking at the Bollinger Bands and the Keltner channels for the S&P 500, we are still, right around the midpoint, in the upper half technically of the Bollinger Bandwidth. Well, obviously, we're not above the Keltner channel anymore. We're not above the upper band anymore. Momentum is waning. Now the momentum has really dropped on the Qs. It hasn't gone negative yet, but it's really dropped down there, and it's dropping pretty quickly. We are in the lower half of the range. Now, granted, again, the first part of the year, we did get in the lower half of the range as well. You can see we kind of had a similar MACD pattern then, a little bit bigger, more robust this go around, but same idea, and we were dropping in the momentum. We never did go negative, and then we rebounded. In fact, we rebounded by the time we got the red dots, and you would expect that would be the case again. If you look over here, you can see the bandwidth was falling just like it is now, and we dipped our toe down we didn't get into lower half of the chart, did not get to lowest quartile, and very similar to what we're seeing here. So again, we are set up, even on this indicator, to bounce off of this level on the NASDAQ 100. If you take a look at the intraday signs here, you can see we closed below last week's low point and the 4-week midpoint on the intraday chart. So lower high, lower low, closed below yesterday's low, last week's low, and as I said, the midpoint. The point of control is still much lower, so it's still way down there, and you can see we haven't dropped below 70 yet. Now we have on the Qs, right? So the Q, this is another area where the Qs have gotten a little bit more bearish. We have dropped below 70 on that, which means the low points way over here were set for a new low point to occur. Excuse me, the high has moved over here. That's what the green line dropping below 70 is. The high has moved. We have gone, however many days now without a new high point. We do have a what looks like a runaway gap. We are way below last week's low, way below the midpoint. In fact, when you look at it on this chart here, we have really dipped down, right? The S&P is in the lower half of its chart, not quite in bearish territory yet. The Nasdaq's not only in bearish territory, but it actually got into that lower reversal zone. It did not do that at the beginning of the year. So another sign, another difference. There's a lot of similarities between now and the beginning of the year, but there are a few differences that suggest we're more bearish now than we were then in that time frame. You take a look at today's trading range and volumes. You can see we were above average, very strongly above average in the range, above average in the volume, and you see that showing up in a in a rising ATR, relative ATR. You can see it's well above 0.8 now, up above 0.9 and working its way. It's not above 1% yet, but it's working in that direction as the ATR is rising. The volume is at very, very low levels. The Qs, you can see, has really taken off. It's up well above 1%. Again, it's 1% is actually its extreme to the downside, so it's up to almost 1.5% and is higher. Again, if I look at the beginning of this year, you can see the range did not get up very high. Right, it stayed down at relatively low levels. The volume was not picking up. That's a much different scenario now, where volume has been picking up, and we have a much bigger increase in the ranges, again suggesting we might be a little bit more bearish than we were back then. Looking at the volatility index, you can see the VIX was briefly above 16, definitely closed above 15 today, and closed above the 95% mark, and the VVIX goes above 90. So those are all pretty significant levels. And when you look at the VIX relative to its average values, it closed above its 200-day average value. Barely yesterday, but significantly today. So again, when it gets like this far above its average value here, if I were to change this to 1/200, again, we're going to compare to the beginning of the year, right? We had a very similar pattern. So here's the very beginning of the year. You can see the VIX did not get above its 200-day, did not have that big of a range or big of a move, and we are now. Very, very big move. Lots of momentum here that we didn't have then. Strong sentiment is what this is measuring. Strong bullish sentiment for volatility, way above the 200-day average. So a lot different scenario on the volatility index, suggesting again that the market is a lot more bearish now than it was then, and suggesting that there is a high probability that we are going to start with this move, that we are going to start an intermediate decline. That doesn't mean we won't go up tomorrow. I think there's a very good chance we go up tomorrow. I don't think we will go up enough tomorrow to really kind of change. You can see when you get a big down day like right here, you can see my cursor barely here. There we go. So when you have a big down day, where it looks like you're going to start an intermediate decline with some very bearish short-term sentiment, we still went up the next day and before eventually rolling over. And you can see a lot of these other instances. We got the bull tag. We went up the next day. So a lot of times we can go up when we haven't even gotten the bull tag yet. But we can go up here the next day before we move on. So it's a question of how much will we go up. And again, if we only go up a little bit tomorrow, then we know. See, here's your bull tag here, where we actually went up for a few days, for a week. It never got out of the range, and that's the key, right? Is do we close back above the bull tag's high point, right? If we were to close above this high point tomorrow, then we're going to be good to go, right? Very, very good to go. As you saw, we had a good run after that bull tag at the beginning of the year. So we'll be good to go. And we didn't get it the next day on January, but we got it over here. But if we can't close above, and I would say not just today's high, which is the bull tag high, but you'd have to close above, this would be Wednesday's high. Getting into that gap. If you were to close above Wednesday's high point, then we're good to go for a good bullish bounce up. I think the probability of that is very low. I think it's more likely we bounce up but stay within the range of the past couple of days, before breaking below the low of the bull tag, which continues to trend back down to the downside. So something to watch for tomorrow. All right, now let's take a look at what's driving this price action. Check this out. So for the first time in who knows how long, the Qs have a shorter, smaller 3-month return than IWM has. So it's, again, that's not very common. It hasn't been common lately. But IWM now has got a higher return than the Qs over the past 3 months. Of course, commodities, the dollar, still lower here. Let's look at just today alone, because today was kind of an interesting day in terms of who was the worst performer. At the start, it was the Qs again. IWM was down, but then IWM ended up with by far the biggest loss. The Qs ended up only with a 0.5% loss, well off of its lows of right around 8%. But the IWM was down at one point, down 2.5% before ultimately falling down just 2%. But still, that's a pretty significant drop. You can see the dollar rebounding in a big way. And we talked about how we didn't really expect the dollar to really break down below that 200-day moving average by a significant amount. And a big rebound here, kind of a, what would that be? There's a candlestick pattern for that. There's a candle where it gaps down and then finishes up higher like that. I can't remember what that's called, like a piercing line. I think the piercing line's on the other end, so it'd be the opposite of a piercing line pattern. But you get that, it's a bullish reversal pattern. No matter what it's called, it's a bullish reversal pattern. And you can see, that would not necessarily be bullish for equities if we were to continue on that run. If you were to look at the 10-year yield, which is the other big factor, it was up 4 basis points today, up 1%. Another big factor in weakness. You can see short-term sentiment still in bearish territory, so it's not like we've really turned things around here. So no big concerns coming off of the cluster yesterday. But again, any change in direction there on the 10-year yield will have a significant say in the markets. And then finally, commodity prices. We're also flirting with that 200-day moving average, and dropped down significantly today. Crude oil is still holding its 30-day average, but you have a bearish MACD, you have a bearish stochastics, some pretty decent volume on that futures contract. So we'll see if that rebounds into what it does off that moving average, whether it changes directions or moves back higher. This has definitely been at least a near-term decline on crude oil, and I would say bordering on an intermediate decline here, where the intermediate line itself falls into bearish territory. Give it a second here to load up. You can see where it's definitely fallen out of bullish territory, and you've had some near-term drops here, and again, it doesn't look like we'll get a bullish near-term low as 2 days where we haven't been able to get above 80. After a nice big move higher yesterday, we weren't able to follow up with it, and we dropped back down. Now we'll see whether we get a bull tag or not, as we have the light pink shading, and if we end up with a yellow line, do we get a bull tag and bounce off of this, which is kind of what you would expect, at least what I would expect would happen here. Remember, that's the three-headed monster: rising yields, rising dollar, rising commodities, especially crude oil. Those are the three things that generally puts pressure on equities. One thing that was kind of interesting, a relationship that's really deteriorating the last few days, last week, is copper relative to gold. So I wanted to show the longer term chart to show you how close we are to breaking below multi-year lows, lower than where we were in 2022. So really close to breaking multi-year lows. Now let me zoom in on this relationship, which has turned slightly negative, but traditionally is very positively correlated with the S&P 500. But I mean, that's a significant breakout below 50 to get to 52-week lows. Big time drop in momentum. You can see the MACD has dropped below zero. It has also dropped below zero on the weekly chart, the MACD itself. And you can see strong indicators suggesting that this isn't just a little bit of a dip, right? This is kind of a breakout move to the downside. And of course, the relationship we've been watching quite a bit is the Qs relative to IWM. You can see it had dipped below its 200-day moving average, rebounded, fell throughout the day today, but ended up right there about 2.2, very important level. Its MACD is extremely low, extremely low. The long-term MACD is turned below its moving average with some bearish short-term bearish indicators. We'll see if that continues. Again, this is very positively correlated with the markets. So a break below that 200-day moving average would kind of be the last thing we want to see right now. Because again, that another sign that we would be more bearish. Again, at the beginning of the year, there's where we were at the beginning of the year, right? We had come down to the 200-day moving average, and then we bounced. Remember when that bounced, so did the NASDAQ and the markets and everything else. So if this can do the same thing and bounce back above moving average, now you're a lot closer to getting above like the 8 and 17 day moving averages there. We're nowhere close to getting above those now. So again, a much different scenario, much more bearish in terms of the bearish momentum, much bigger histogram than we saw at the beginning of the year, much lower level on the MACD than we saw at the beginning of the year, higher ADX and negative DMI that we saw at the beginning of the year, and we didn't drop below 30 like we did now at the beginning of the year. So again, the momentum is definitely not in our favor for this, and the breadth was, wasn't nearly as extreme. You can see we are very, very minimal breadth at the we had good breadth at the end of last year, but by the time we got to the beginning of this year where we formed those lows, very minimal breadth. Not the case right now. Extremely high breadth the last few days. You saw the McClellan oscillator had also jumped up to some pretty decent highs, pulling back down a little bit here today. I'll give it a second here. Dropping down to 21, so back below that 35 level. Did make it above 500 on the summation index. And again, we'll see how. Remember, we were already above 500 at the beginning of the year. So in fact, we were above 1,000 at the beginning of the year when we had that bounce back up, or at least we were really, really close to 1,000 when we had that bounce back up there. So a little different scenario in that regard as well. We had much, much stronger breadth. If you take a look at some of these sectors and how they're performing, I think I showed you XLI relative to the S&P 500 and how it really broke through. You can see kind of holding the 50-day moving average. Here's the energy sector holding right now the 50-day moving average. Remember, these are all, but you see its MACD's turning positive. These are all sectors that are very, very negatively correlated. And of course, XLB, which has got those copper stocks like FCX, also as of right now holding. Break above the 50, things change. Holding the 50 because you notice we're getting significant rotation into all of these areas. In fact, one of the tweets I put out here earlier today was this one here. Let me right click and throw this over so you can see it. So here's all those sectors and their correlations over 3 months. The correlation of their relative strength lines versus SPY. The correlation of those ratios to SPX over the past 3 months. You can see negative 94% for staples, negative 93 for energy and materials, negative 92 for industrials, 89 for healthcare, 85 for financials. So it's great that we're rotating into these sectors, and a lot of people are talking about the great rotation. The problem is these aren't the sectors we want to lead because they are negatively correlated with the S&P 500, whereas these other major big sectors, mega cap tech sectors, are all very positively correlated with the S&P 500. And again, on a day like today, let me pull up the sector comparison chart. Wasn't actually too bad. XOK, you can see now, does not have the strongest 3-month return. At the lows of the day today, we kind of continued what we had seen. Technology was down quite a bit, but by the end of the day today, technology, communication services were flat. Discretionary is down 1%, but so were all these other sectors: industrials, financials, materials. Only energy outperformed everybody with a small gain. Healthcare down 2.3% a day after United Healthcare was so positive, especially for the Dow Jones Industrial Average. All right, now let's take a look at our trade idea of the day, which is actually in the material space. It's on FCX. FCX really breaking down hard today. It has been in the intermediate decline since it got its bull tag back here at the beginning of June. Tried to get a rebound going here but failed, right? Failed, and now we're breaking to new low, multi-month lows. Have earnings coming up. The intermediate line is below market sentiment, falling into the lower half of the chart. Short-term sentiment is very bearish. You're 7% below the moving average, so you are in bearish mode here. If you look at its weekly chart, you can see, it's not like you're in a death cross environment either. Like we do have the red arrow, and you're close to breaking below the 40-week moving average, but you still have, even with as far as close we are to the 40-week moving average we are on the price. You can see, if I were to change the candle, pretty close to that 40-week moving average, but the PPO still pretty high. So for us, it's kind of like this, when you also got pretty close to the PPO and it broke through. So with a good strong move, with a red arrow and a big move coming into earnings. This is actually before earnings. Some of these moves were actually after earnings. This one over here was after earnings, before its rebound. If you take a look at its 3 green arrow charts, you can see we definitely have 3 red arrows, and with some pretty decent volume too, more than 1.5 times the average volume. So pretty bearish from that perspective. You're breaking below the 50-day moving average, working your way down, as I mentioned, close to that 200-day moving average of 40-week exponential. The MACD is bearish, stochastics is in lower half of the chart, moving lower. You can see there's a lot of bearish breakout patterns showing up on some of these other indicators. The DMI, you can see above 30, below 20 on both of those. The ADX is still low, so suggesting a trend may just be developing. If you look at the RSI and the CCI, they're also down the bearish levels, below 40, below minus 150. On the weekly chart, the CCI is finally breaking below 100. So again, maybe just beginning a bearish trend to the downside. If you look at its Ichimoku cloud, you're obviously going to be below the cloud. Pink, we've been pink for a while here. Remember that rally didn't really help us. So, we have pink shading. We're well below the cloud, negative rate of change. But we have a weak bearish trend. So we haven't even really started a mature trend at all on this. So there's an opportunity that we can continue to go lower there. You're obviously going to be below both the lower band, Bollinger Band, and the lower Keltner channel. So a big breakout move. But the momentum is still bullish, right? And we still have red dots. So again, another sign that we may just be beginning this move down to the downside. So what I decided to do here is say, okay, well, let's take a look at its options trades, and we'll sell a pretty aggressive delta. Generally, when you go for a 20 delta, you're going to get a pretty good 3-to-1 reward to risk ratio, and you're going to be right on the edge, or maybe even up to 4-to-1. Here, we go all the way down to the 15 delta, and we're only getting a 3-to-1, right at 3-to-1, and we have a lot of flexibility for timing. So it's, even though it's a low delta, the market's telling you, at least the options market's telling you, there's a pretty good chance that it hits down to that level higher than what the delta would suggest, based off the pricing and the implied volatility of these options. So that's why I decided to do that. Again, normal risk, pretty good return. And if it bounces up again, we can keep our risk very, very minimal there. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.